Welcome everybody to another episode of the weekly market update. I'm going to be breaking down the markets and then I'm going to be breaking down a few key stocks. So let's get right into it. S&P 500 finishing down 0.92% on Friday. It was pretty much a flat week. What we can see here is we have lower highs and we have higher lows. So this week I expect us to probably stay above something like 590, but probably beneath 610. Now, if we get some bullish catalysts or some bearish catalysts, if we break and hold above 610, that could squeeze us past all-time highs. If we really start breaking underneath 590, then the next support that I'm looking at is something like 582. And if it breaks underneath that, then we're looking at a deeper sell-off. But for now, the market just looks range-bound. And when we're in a range-bound market, that's really good for options sellers. Okay, so selling bullish put credit spreads, you get paid as long as the stock goes sideways or higher. Selling bear call credit spreads, you get paid if the stock stays sideways or goes lower. Those are the strategies that I'm looking at for this week. And then once we break that range, then I'm going to be looking at buying call options, or if we break the range to the downside, I'll be looking at buying put options. Next up we got is the QQQ, the NASDAQ. NASDAQ pretty much sideways. So NASDAQ would be bullish QQQ above 534.50. It would be bearish underneath 510. There is a bit of a demand zone, so it's not just like a clear-cut support level. This is kind of the demand zone. The thing is, though, is sometimes if you play too much of the zone, by that time it might be too late and the market could break down. So I'm really not bullish, I'm not bearish, I'm just neutral, and I'm going to be playing key stocks. So I'm going to be buying relative strength and shorting relative weakness. If we take a look at some of the stocks within the QQQ ETF, we can take a look at Google. Google was my largest holding, and it still is my largest position. And I had a huge position going into the earnings report, and luckily I trimmed about 2/3 of it in front of the earnings report. Google did have a bearish earnings reaction. They spent too much on investing in AI, so capital expenditures were super high. So Google, we are starting to drop, doing a little bear flag. We might drop and maybe test something like 175. I do think that, in my opinion, that's where I'm going to be buying the dip. And just because I'm buying the dip doesn't mean that you should. This is not financial advice. This is all for educational purposes only. I don't know you, your situation, your risk tolerance, your time horizon, your liquidity needs. Like, do you need this cash to buy a home? Do you need this cash to have a wedding, to buy a car, to, invest in your business? Everybody's situation is different, but when I'm looking at Google, I like that 175 level. I do think longer term it can get to $230 per share, but it might take a bit of time. Okay, so I'll potentially revisit Google a bit later. Next up is Amazon. Amazon reported earnings on Thursday after market close. And going into Friday, Amazon had a pretty bearish reaction, down 4%. This was within the expected move. So most option buyers actually lost money if you traded Amazon prior to the report. So Amazon kind of looking like we broke this balance range bearish for now. I'm just going to wait on Amazon. I'm kind of just neutral. I don't think Amazon crashes. I don't think it just rallies straight back up to the highs. I really need the chart to develop. Okay, so stay patient on a lot of these big cap tech stocks. That's basically what I'm saying. Meta, really, really strong. If you guys paid attention to some of the prior weekly game plan videos that I did a few weeks ago, I noted that Meta is probably going to have a bullish earnings report. And Meta made it super easy on me because it rallied in front of the report. Whenever it does that, I can take a good chunk of profits and then just risk a tiny amount, like a call spread or something like that, before the earnings report. And boom, Meta, paying off. Now the chart's a bit extended, but I really like the relative strength of Meta compared to all of the other markets. So if Meta, if Meta could come down to like 630, I do think that is a short-term dip buy. I'm not going to short Meta up here. I think cash is the best position. I'm basically positioned in mostly cash with a few long positions and a few other positions in uncorrelated markets. And we'll cover some of those other markets throughout this video. So that's Meta. Looks bullish. Just wait for a dip. And I like buying the dip on Meta. But for now, I'm just going to leave it alone. Next up is Tesla. Tesla's looking a little bit more bearish short term. So Tesla had this kind of pennant formation going on. We had lower highs. We had this flat bottom. And we really just stayed in this range for a long period of time, all the way from December into early February. Tesla's been in a range of 400 to like 450. So if Tesla really breaks above something like 420, yeah, that's a good number for Elon Musk. A break above 420 could be a bullish breakout to the upside, but currently we are breaking down. And if we just kind of draw out this support range, this is about 380, I'll call it. Tesla's bearish as long as it's underneath $380 per share. The next key support area I kind of see is 322. I'm really interested in investing heavily in Tesla longer term, down to this like 277, down to like 240 area. I think that that's my personal dip buy zone. For now though, I'm just going to let the chart develop and I'm going to wait. Longer term, I do think Tesla can get to something like $700 per share, but it probably doesn't do it this year. It doesn't do it next year, maybe 3 years from now. But I'm thinking like 5 to 10 years, if Tesla can get self-driving on point, I think that Tesla can get to $700 per share. But for now, the risk is really, really high based off this chart pattern, okay? Netflix, all-time highs. Beautiful, beautiful move. After earnings, goes sideways, digests it, and this week, a nice little breakout. Netflix had some really good day trades, just buying over 1,000, take profits. Dips comes near 1,000, take profits. So Netflix now, again, a bit extended. As long as it's above 1,000, the short-term uptrend is intact. Netflix, by traditional fair value metrics, is overvalued, so it does carry more risk. The RSI is overbought, although recently it's showing bullish confirmation where RSI is making higher highs as price makes higher highs. But if you measure from back into November, this is still a bearish divergence, as in the RSI has not made higher highs relative to where it was in November. So price makes higher highs, but the momentum is stalling just a little bit. So it's important to be mindful of how price is moving when it breaks to new highs. Is it doing it on stronger momentum or weaker momentum? Can the momentum catch up, or is price going to catch up to momentum? That's what we want to be reading as technicians. Next up is Microsoft. If you guys saw last week's video, I noted that you could sell Microsoft 380 bullish put credit spreads, basically saying, Microsoft, over whatever expiration date I choose, if I think that Microsoft is going to be holding above 380, pay me the max profit. And I entered that trade on Monday and actually took profits in the middle of the week. Took a nice 20% gain in 4 days. I'll take that, especially since I was kind of sniffing a sell-off. You know, the Qs were at the top end of their range. They're starting to reject that resistance. Let's take the quick money, get back into cash, and we can always just reload it if Microsoft continues to sell. This is a bearish engulfing candle. And so usually those, they go lower over time unless you take out the high of the bearish engulfing. So Microsoft is a breakout buy over 420. Otherwise, I think it's a dip buy near this like 390 zone all the way down to 380. If Microsoft is breaking underneath 380, I'll need to reevaluate that trade. Longer term, I like Microsoft shares. So I think that the shares can get to something like $490 per share longer term. So I grade Microsoft as a dollar cost average type of investment. That's what I'm going to be doing. Maybe buy 1 share a week. Maybe buy $100 a week. Just, I'm going to be buying this and putting this in my Roth IRA. Of course, being mindful of total portfolio allocation. But Microsoft, if you can accumulate it down here, you can probably get a good return in the long run. That's not guaranteed, as with anything in the stock market. Markets can crash, news can come out, crazy stuff can happen around the globe, so be ready for anything. We also have CPI on Wednesday, and that can affect all of these charts, bullish or bearish, okay? So be mindful of that. It's kind of like the market has an earnings report in the middle of the week. And I will be trading futures live on Wednesday. I'll be trading futures live Monday, Tuesday, Wednesday, Thursday, Friday with victory trades. But on Wednesday, CPI is going to create a ton of volatility, and it's going to be really, really good for day trading. Okay? So that's Microsoft. Taking a look at Apple, AAPL. Again, kind of just going sideways. Ever since the earnings report, that was a neutral earnings reaction. I set up an iron condor prior to the earnings report, and that paid off the max profit, which is really cool. Now we kind of got this drop bear flag. Are we going to drop again? or is it going to stabilize and find some support at this bottom end demand zone? Apple, I'd be leaning neutral / bearish unless Apple gets above 235. Okay, so that's Apple. Now let's check out the IWM, the Russell 2000. Really, really choppy chart. And IWM has been underperforming for a long period of time. You know, it hasn't made all-time highs since, oh my gosh. Okay, it's been a few months. IWM made all-time highs in November, okay? But still, it's been a while. So let's see if IWM can't catch up on the monthly time frame for IWM. Keep an eye just on that trend line. Not so much to like trade off of it, but just use it as a visual, okay? As long as that uptrend is intact, the market is still strong and it's in a good bull market. If the IWM takes out this trend line, that's a red flag, or at least a yellow flag, maybe an orange flag, something in the middle, and that would be a little bit more bearish. But that's the overall IWM. Look at this nasty monthly false breakout back in late 2021. Look at this. Digestion sideways for a long period of time. That energy should be released to the upside, but when it doesn't and it zips back in, you know, you could call that a liquidity grab, manipulation, a jab, false breakout, whatever you want to do, because that should have taken the IWM much higher, but 2022 was a bearish market year, and the IWM was probably a big reason as to why that happened. You know, if we just compare the IWM back to SPY on the monthly time frame, SPY didn't really have that false breakout. It kind of just shimmied on lower, makes a lower low, lower high, lower low, lower high, lower low. Bull flag holds the higher lows, higher high, higher low, higher high, bull flag, pop, higher high, quick retest, come back up. And now we're just going sideways. Are we going to go sideways and break up? Are we going to stay sideways for longer? Or are we going to see a little bit of a correction on the monthly time frame? That's why we got to watch those key price levels. We got to take a look at things like the VIX, the Volatility and Fear Index. And VIX coming into a little bit of support. This is a bullish engulfing candle. So VIX is signaling that we could see a bit of rise in volatility and the markets could sell just a little bit. But if the VIX can start to come back in and then start to break underneath Friday's low, that just kind of tells us we're going to be in a grindy, choppy market, maybe with a slight bullish bias. Okay? So that's the overall VIX. Let's check out SMH, semiconductors. So semiconductors are all over the place. I'm going to clear this drawing chart. Look at this. Just here's our lows, here's our highs. Kind of break the upper end of the range, break the lower end of the range. You know, this kind of looks like a megaphone, and megaphones are tough to trade. That's where you're making higher highs and you're making lower lows. It basically punishes all breakout traders, punishes breakout traders that sold short, punish breakout traders that bought long. SMH, I'm just going to wait on that. You know, for a period of time, you know, back over here, back over here, back over here, I've been saying SOXL is really good for the wheel. SOXL is a triple levered semiconductor long. So SMH goes up 1%, SOXL goes up 3%. But if SMH goes down 1%, SOXL goes down 3%. And a big risk with triple levered ETFs is they decay away, because every time that they go up and down, it chips away a little bit more of the price. So as you can see on SOXL, you kind of see a little bit more of a downtrend. And that's just the nature of it. I'm going to hold off on wheeling SOXL. You know, I got called away up here at about 32, you know, a while ago. And I was just like, I'm going to leave it being called away. And that was a good decision. Now I can patiently wait. And if SOXL can break down to like 20 or 19, then I can open up more wheels on this. What's really nice about the wheel on SOXL is the premiums are really high. So if you can potentially not get assigned on your cash secured puts, it keeps you liquid and you can get a decent, you know, ROR, return on risk. So this column over here tells us how much you would get paid if you commit to buying 100 shares at that price. So if I wanted to this week, I could sell the 25 strike cash secured put on SOXL. I'm not going to do that, but for example, if I were to do it, I would get almost a 3% gain. I'd get 2.92% guaranteed if I commit 100 shares to buy 100 shares at 25. So that's a free $70 profit if I make that commitment. You can exit the trade at any time, but I like to just stand with my commitments unless there's a drastic change in the overall market. So SOXL, wait on the wheel. That's what I'm going to be doing. And then if it gets oversold enough, I'll reinstate that wheel and I'll kind of split the position. Maybe I'll do like 100 shares at 20. And then maybe I'll do like 100 shares at, 17. And from there, my position is fully built out. I can always roll the covered calls. And as long as the SMH doesn't go to zero, I'll have some sort of an investment with weekly cash flow. So that's really, really nice. If we take a look at some individual stocks in SMH, NVIDIA, holding up pretty well. We had some bearish reactions from DeepSeek, bearish reactions from tariff news, but it's been holding up pretty well. Up here, I was saying NVIDIA is a buy, and it was basically right over here, like 140. NVIDIA made an all-time high, then did that false breakout, breaks out, zips back in. That's not a good sign. That's when I downgraded NVIDIA to just a hold. I'm not going to rush out and buy NVIDIA. I'm not going to sell NVIDIA. I think it's a hold. I really like NVIDIA down here at 90 to 80, okay? If I'm going long-term, I think just dollar cost averaging into SMH is the way to go and not get cute with it. Another individual stock is AVGO, Broadcom. And Broadcom, again, all over the place. No breakouts just yet, but if Broadcom breaks above 250, I like that breakout setup. This is just a nasty, messy chart. I'm just going to stay away. There are better stocks to trade than some of these right now. Next up is gold. Gold should be getting a lot more news because gold has been hitting all-time highs for a couple days in a row now. And if we take a look at the weekly chart, beautiful, steady Eddie uptrend. Monthly time frame, a beautiful monthly breakout. We took leap call options over 193. Since then, gold's up 37%. Gold rarely ever drops that much. I mean, here's a 40% drop from, 2013, to about 2016. So gold can have some bear markets. I don't see that happening anytime soon. If gold can retest something like GLD 255, I think that could be an entry point. Gold is still fine as long as it's really holding above 225. I think that would be the final dip buy. I really wouldn't want gold coming all the way back into 193. Technically, it's still fine if it's there, but from the highs, that would be a 26% drop. So you wouldn't expect a fast rebound back up to the highs. You'd need it to put in, higher highs and higher lows from there, maybe consolidate, do something like that. Otherwise, gold, I'm not going to speculate too much on the price. I'm just drawing out some scenarios. But gold, it's really holding its steady uptrend. It's having those tests, breakout, retest, breakout. It's kind of already retested it. So, maybe I'll just stick with day trading GC futures. So these are the gold futures contracts. You can also trade MGC. MGC moves very peacefully. So if you're new to futures trading, just paper trade some of these and see what you can get out of some of these moves. Okay, so that's gold. I'm going to quickly recap some of the trades from last week and then give my updated analysis on it. Let's check out oil. So /CL. Oil. Last week I said I was looking for a bounce in oil. Oil kind of just went sideways to slightly lower. What I did was actually I sold the UCO 28 strike cash secured put. And so what's cool about that is I got paid a premium to do it. And UCO closed right at my break even. So it's kind of like I just bought UCO right at the close on Friday. So my average cost is about 27.38. Current price 27.40, 27.38. But if oil can, break this downtrend right here, then oil I think could see a nice pop. CPI on Wednesday is also going to affect oil prices. So just be mindful of that. This is a smaller position for me. It's only 100 shares. Normally I'll do something like 200 shares if I'm feeling pretty good about it. Maybe 300 shares if I want to. But I'm collecting that weekly income and it stabilizes the portfolio. It adds diversity to the portfolio because you're not just fully invested in tech stocks. Oil, its correlation goes in cycles as most correlations do. But oil, its correlation coefficient is like 0.34, meaning it's mostly unrelated with the SPY. You're basically kind of trading inflation You're trading some of the gas prices. But oil, we got this wedge breakout, and now we're kind of coming into that support net from the breakout zone. If it starts to break down, that'll be a little bit more bearish. I would manage my risk and probably exit the trade. But I want to see if oil can get a bounce this week. I do not know what the futures are going to do. I'm recording this before the Super Bowl. So comment if you think the Chiefs are going to win. Comment if you think the Eagles are going to win. Okay? I'm not going to place any bets on this game. I did place bets on Chiefs beating the Bills, and that paid out. So that was pretty cool, but I'm not going to bet on this game. I'm just going to watch it, enjoy it. Probably study for a few of my certifications that I'm working on. More updates on that in the future. Okay? But that's oil. I like it for the wheel. Staying cautious, though. That's my overall thoughts. Next up is PAN-W, Palo Alto. So Palo Alto, I like the stock long term. I think that the stock can get well above $400 per share. It's one of the leaders in the cybersecurity space, and we need cybersecurity. Also, the chart looks pretty good. You know, we had a nice sell-off, a nice bounce, and then once we started to dip and curl, that's where I started taking my PAN-W longs. Stop was underneath 179.50. That stop held, which is victorious. I love it when the stops hold. And we get a nice little pop. I sold bullish put credit spreads and bought some leap call debit spreads. And what's cool about that is the total cost of the leap call debit spreads only costed $360 or 3.6. But $360 can turn into $1,000 if PAN-W can close above $220 per share by January. So that's a cost-effective way to potentially invest. You are putting a time frame on your investment, but PAN-W is, in my opinion, very likely to close above $220 per share by the end of January 2026. They do report earnings right here on February 13th, so that is important to note. And that is, this next week? Yeah, expected move is $17 on PAN-W. That's a decent expected move. It tends to move big, either to the upside or to the downside. I might trim some of those leap call debit spreads in front of the earnings report. And again, those bullish put credit spreads, basically me just saying, hey, I think you're going to stay above 180 this week. Those are really nice because I made a credit of 70 cents and it was a $2.50 wide spread. So what's nice about that is my total risk was $180. Am I going to risk the full $180? No, I don't need to. I can always stop out early if I want to. But a credit spread in its nature has such a high probability since you're selling options. And then I get one green day, spread is at like plus 50%, of the total credit that I can make. Another green day starts to move up even more. And then Friday was the killing shot. Friday destroyed all of the puts. The put premiums are mine. So keep an eye out for bullish put credit spreads if a stock is at a strong support level and it's holding. Okay, that's a really good option strategy. And if you think the expected move is wide and you think the stock is going to stay within that expected moves range. Okay, so that's PAN-W. Next up, a quick little win on APLD. Quick little buy over 8. Made a move up to 830. I just did long with covered call. Not much there. Maybe if it sets up again, I could wheel that again. But that's APLD. NFE, I was a little bit early on. I've been wheeling NFE for a while. Down here at 8, up here at 11, up here at 12, even up here at 14. Then I had no position on NFE up here. You guys heard that I was waiting for a dip. Well, we finally got a dip late Thursday. I went long at about 13.20. So I am a bit underwater on this trade. Stock is trading at 12.26. But guess what? I can wheel this and I can collect pretty good option premiums. And I still gave myself room to add to it at least once. But what's cool about New Fortress Energy is that its fair value is near $20 per share. Stock is at 12. It pays a 3% dividend. So my upside is pretty good. 50, 60, 70% upside. Plus the 3% yield while I hold it. Plus I can wheel covered calls at my entry or higher. I'm probably going to sell 14 covered calls. If I want to be conservative, I can sell 13.50 covered calls. And if I get called away for a profit, boom. The biggest risk with this stock is since it went from 782 all the way up to 16 in just like 2 or 3 months, it can retrace a little bit more, but it's very likely to find some sort of support at some point. Okay, so that's just that was the only expense trade that's underwater currently, but still has yet to be realized loss or realized profit. Okay, BXSL. This one had a nice breakout over 33.43. This stock pays a 9% dividend. I got a nice move up, but I basically just took a tiny little paper cut on this when it didn't want to work. So I'm just going to wait on this setup, but I like this stock if it can break above 33.62 and hold. But that pays a 9% dividend, okay? Next up is TSM. This has been a nice, good winning stock for me in 2025. Accumulating TSM in this range, we get a release to the upside. Boom, take profits at 220. We come back in, buy the dip, take profits at all-time highs. Trim a little bit up here. I did leave some of my position and got caught in some of this gap down. But guess what? TSM recovered. I did a TSM Iron Condor for March, basically saying, TSM, I think you're going to stay above 200, but beneath 240. So the longer that TSM stays within that range, the more premium I collect. It's called positive theta. So as an option seller, you get paid to hold on to the trade. You're incentivized to hold on to the trade. When you're an options buyer, you're not incentivized to hold on to the trade unless you really think you can get a gamma squeeze to the upside. Because when you buy options, you're negative theta. So you're paying each and every day to hold on to that option. You might be right on the direction, but if it takes too long to get there, you end up losing out on that trade. And so it's like, one big thing that I've switched over to in the past few years is going from options buying to options selling. It's basically, do you want to be the player or do you want to be the casino? Sometimes the players win big, sometimes the casino loses big, but most of the time the casino wins and the casino builds up their profits over time. That's the same way with options. And then you can fine tune that and build an edge when you do options analysis, when you do technical analysis, and when you do a little bit of fundamental analysis. You can always cross-reference. You can use AI to help you out. You can use Yahoo Finance to help you out. Check in on other YouTubers. What are they saying? What are their thoughts? What are their opinions? Are those YouTubers making you money? If they are, great. Stick with them. If you're losing money watching them, find out why. Is it you? Is it the YouTuber? Is it a mixture of both? Nobody can make those buy and sell decisions besides you. That's the most important thing, okay? But TSM was a nice Iron Condor win. All of these trades were alerted, by the way, this week. Another good win last week was MSTZ. MSTZ, I told you guys that this can be wheeled as a crypto hedge, and the option premiums are just so high. So we sold the 12 strike cash secured puts, or was it the 14? Sorry, it was the 14 strike cash secured puts. These were selling for about 1.9 in premium. So literally I'm making like a 20% return to agree to buy 100 shares at $14 per share. So MSTZ goes up when MicroStrategy goes down. And I think that if you want to hedge a crypto portfolio, you can use MSTZ as that vehicle. And as long as, Friday's low is holding, MSTZ has the chance to rally, which would be bearish for MSTR, MicroStrategy, aka Strategy. That's the new name of the stock, Strategy. They got the strat for you guys. The strategy is seeing a downtrend. For now, I'm not making fun of MicroStrategy. Michael Saylor is a cool dude, but his stock price looks questionable for now. I think that there could be a good breakout if MicroStrategy or Strategy breaks over 407. Otherwise, there's a bearish breakdown underneath 291. If it breaks 291, don't be surprised if the stock drops like 30% in a few weeks. I'm not saying it has to. It's just that's the technical setup. A lot of those buyers would have to give up. Okay? If we take a look at Bitcoin, I'm going to use IBIT to chart out Bitcoin. I don't like reading 96,285. That's the current price of Bitcoin. Bitcoin needs to hold above 100K for it to be really, really strong. Right now, Bitcoin just looks neutral. Ethereum is pretty weak. I was thinking Ethereum could potentially be rotated into back when it was, hanging out at 4,000. But you have a strong double top and a breakdown. Ethereum looks really, really weak. Bitcoin looks neutral /BTC. So IBIT, I really like the breakout long on IBIT over 61.20. Otherwise, just use Bitcoin as kind of like an indicator, a risk on or a risk off indicator. Bitcoin tends to be a leading indicator. So if you see Bitcoin selling off, it generally means that it's risk off and the overall market might see a bit more sell side pressure than you're used to. Okay. Especially in the markets that we've been in since 2023. It's pretty much been a steady uptrend. There hasn't been any big pullbacks. And so you need to be on guard for volatility, but also trade what you see on the chart, okay? Next up, let's get into some trade ideas. First up is Celsius. Now, Celsius, the fair value of the stock is $32 per share. The thing is about Celsius is I don't know if it has a really strong economic moat. You know, there are so many energy drinks out there. Celsius is pretty good, and if they can sell a lot of bundles and move a lot of inventory, their margins should be pretty high. It is more of a cyclical stock, and it should outperform a little bit in the summer. But on Friday, I sold the 0 DTE 2250 strike cash secured put. So just one of those. And I got about 0.24 cents in premium. So basically my break even is 22.26 on Celsius. So basically I'm getting paid to buy the dip on Friday. And now if I want to, I can sell 23, 24 covered calls each and every week and get a really good return. But Celsius, I think a good take profit if you're going to buy this dip is $24.93. The risk with Celsius is this is just an ugly ass chart. Oh, so ugly. You know, range, breakdown, lower highs, lower lows, lower highs, lower lows, lower highs, lower lows, lower highs, lower lows. What's to say that this is the bottom? It could just put in another lower high and then another lower low. But the thing is the risk to reward is pretty good. So maybe if I want to, I could risk underneath Friday's low and maybe I can get a good profit near 25. Or what I can do is, what I'm planning on doing is wheeling 100 shares and then I might average down just once near 18 per share. Okay? And then I'll have 200 shares. I can get that weekly cash flow. If Celsius can recover to its fair value of $32 per share, I'll get a nice profit. If not, I'll manage my risk, just like every other trade. But just something worth noting that, you know, Celsius is getting into that point where who's shorting down here? I think you're late to the party if you're shorting Celsius. That's just my opinion though, okay? And I am a chartered market technician, CMT charter holder. I do have some good opinions. Not all of them are great, but a lot of them tend to play out pretty well, okay? Next up is Axon. Axon is a really good, relatively strong stock. Okay, so Axon green on Friday while the markets are just pooping the bed. What I like about this is there's no real good technical buy setups for my criteria, but maybe a dollar cost average program into Axon could be okay. Maybe if we could come back to this trend line and find some support that can offer a buy trade, you know, with a soft stop underneath the pivot that it makes. Something to consider on Axon. That's been a nice, strong stock. Next up is LMT, Lockheed Martin, LMT. This has been selling off pretty greatly. You know, if we take a look at the monthly time frame, well, first off, I want to note this. Rising wedge. Rising wedge breaks bearish on rising bearish volume. You get a massive... LMT can have multiple down days in a row. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Basically 10 red days in a row, a nice bounce, right back into the downtrend. So what I'm looking at on LMT is we're 1, 2, 3, 4, 5. Maybe if it gets like 2 or 3 more down days, selling bullish put credit spreads. Maybe saying, hey, LMT, I think you're going to stay above 420 by this Friday. So LMT, bullish put credit spreads, if it could sell off just a little bit more. And that leads me into one of the questions that I got from Victory Trades members. What do I think of Honeywell? So Honeywell, earnings reaction, bearish, rising bearish volume. RSI is oversold. The thing is that selling pressure is pretty strong. Whenever you close near the lows or close at the lows, who's to say that it's just going to magically bounce up? Unless the market just does. So more downside likely on Honeywell. I also pulled up the Morningstar report These are created by CFAs, Chartered Financial Analysts. So I'm a CMT, Chartered Market Technician. Chartered Financial Analysts, they do the fundamental analysis. They're professionals in that department, while a CMT is a professional when it comes to technical analysis. Okay? But the CFAs, they give a price target as of February 6th of $200 per share. So currently the stock price is at 205. What kind of margin are you really going to get? You're technically buying at a slightly inflated price. Now, then it comes down to where are some buy points? This reminds me of the IWM chart where we broke out and then we zipped back in. That's a false breakout. That could lead to more downside. I'm not saying it has to, but maybe something like 150 could be a better entry for Honeywell. Maybe just waiting for a new setup. I'm not saying it's a short. It could be a short, but I don't see any good locations for it. Maybe 208, but yeah, I'm not married to that idea. Okay? One other ETF to consider for longer term investing, if your time horizon is longer than 5 years, I think that the BOTS ETF can potentially do well. You know, this is a ETF based off robotics and artificial intelligence. Okay, and you can take a look at the fund right over here. Okay, I got the BOTS ETF pulled up. So here are some of the holdings in the BOTS ETF. So you got NVIDIA, you got Intuitive Surgical robots. That's going to help out a lot in the healthcare industry. We got Abbott, we got ABB Ltd, there we go. KN's Corp, Dynatrans. Some of these I don't actually know about, so maybe some of these will turn into leaders, some of these will lag, but I think this ETF can mature over the next 5 years, okay? Let's take a look at some of the individual stocks and sectors. I want to talk about bonds just a little bit. So bonds, again, you're basically lending out your money to the United States government, and for that, they'll give you monthly interest payments, or if you're used to stocks, monthly dividends. So I think that TLT can potentially be a DCA candidate. Buy a little bit every week. It's basically just going to be like a money market fund, but it's going to be a little bit more volatile because as interest rates rise, bonds are going to drop. If interest rates fall, bonds are going to rise. Okay, and right now, I'm wondering if we're starting to potentially knock on the door of this trend line and break out. Otherwise, though, if TLT really comes underneath like 87.50, that would be very bearish for bonds. I think that it could potentially flush. I would be interested in buying the dip near 78 TLT, and I'll be buying heavy. Like, I'll probably buy 200 shares and maybe some like leap call options if TLT can get down to 78. Conversely, if you have a lot of bonds, if you have the 20-year Treasury bond ETF, keep an eye on interest rates. It's still at this upper trend line, and you can always hedge with interest rates by buying TBT calls if it starts to really break above like 36.50. Okay, so keep an eye out on bonds. Next up is uranium, URA. Uranium kind of got this triple bottom action going. I don't know if that's going to be the bottom. Keep an eye on that trend line. Keep an eye on this steeper trend line. But uranium, I'm just kind of waiting for a setup. One stock that I've been liking wheeling lately has been SMR. And I've been wheeling SMR for a while. Back over here, back over here, back over here. Stayed out of it during this period. But then once we started to break out right there, back to wheeling. Boom, max profit. I didn't take any trades on it this last week, but maybe SMR wheel is back in play. They do report earnings, which is on February 27th, but look at the premiums on SMR. I mean, you can get a 3.5% gain guaranteed if you commit to buy 100 shares at 24 this week. Something to consider. I may or may not take that trade, but it's just an idea for now. Again, I don't know how the futures are going to open up. They could be gapping down huge. They could be gapping up huge. They could be flat. So I'll have to monitor the live market environment with victory trades. Next up is XLF, the financial sector. These have been really strong. A bit overbought, mildly overbought. It's towards the upper end of the RSI range. Kind of extended. But, maybe if XLF could come back to 48, that could be a dip buy. Maybe if XLF could maybe come back to like 49.50. I think that XLF, the best way to get involved with this, if you want to, is just the wheel. I wouldn't be looking at going super directionally bullish or bearish, but just cash flowing it. As long as it can stay within a range, you're good to go. And even if it does do a deeper sell-off, you can always just roll out the covered calls. I mean, unless all the banks go under or we somehow have no reason to use the banking sector, XLF is probably not going to go to zero, okay? Next up is XLP, Consumer Staples. Consumer Staples, kind of a portfolio stabilizer. They do pay a nice dividend. You've got stocks like Target in this. Target looks a bit weak. You can take a look at Walmart, WMT. Walmart really, really strong. Guess what? Last week, I noted that if it comes into like 96 area, that could be a quick dip buy. And that was the low of the week. And it did just zip back up to all-time highs and further. We do have a bearish engulfing on Friday. So that does mean we could see sideways to slightly lower potentially on Walmart. Next up, and then there's also Costco. Costco really, really strong. Subscription-based services are really, really good for companies. The dip buy on Costco, short term would be 1,005. Then it'd be something like 967. Keep an eye on that, shallower trend line that lines up with the 970 area. Other than that, though, XLP, decent for long term if you want to stabilize your portfolio or if you want to be a little bit more defensive, kind of like bonds. And speaking of defensive, healthcare. Defensive sector, I've got a neutral rating on healthcare, but it's probably a dip buy if it could come into 141.50. Okay, so that's XLV. And then one other idea for income is IRM, Iron Mountain. Pays solid dividends. We kind of got this downtrend going, but can it potentially break up? It does have earnings on February 13th, but I noticed some politicians buying this stock, and that always intrigues me. Nancy Pelosi, she was buying Pan W near the lows. She was buying Pan W after the earnings report. She's getting in at good deals. She bought Nvidia at some good prices. She's also long on Broadcom, AVGO. She's also long on Google. And so I like those stocks, but I just have to be patient. Okay? So I am hosting a complimentary training with Brandon Carter this Wednesday at 7 p.m. Eastern. So I'm going to talk about options income, how you can collect guaranteed income. The equity will go up or down, but the income is guaranteed, whether the market goes up, down, and ideally sideways. Then we're going to talk about the best way to day trade in 2025, like the safest way, because day trading has a really high failure rate. And so you want to mitigate your risk if you're going to embark on a day trading journey. And then we're going to talk about live trading, how you can join victory trades. I am going to give you the opportunity to join victory trades, only if it's a good fit for you though. Trading and investing, it's not for everybody. But if you like what you see and you think that you can benefit from it, I think you can benefit from it. But that choice is up to you. Sign up for the masterclass. All you have to do is just click that first link in the description and just enter in your information. Boom, you'll get the webinar link for Wednesday at 7 p.m. Eastern. And if you guys have been missing Peter, here's Peter for you. He's alive, healthy, and well. He's a big boy though. Look at him. Look how big he is. He's a big cat. He's probably like 14 pounds. We don't overfeed him. He likes to sleep, eat, as with most cats. We'll take him on walks occasionally. But I hope to see you all at the masterclass on Wednesday. We're going to be talking a lot about stocks, ETFs, different strategies, what works well, what doesn't work well. I've got a really, really good presentation for you guys. It'll be really exciting. Okay, so click that link. Comment down below who you think's going to win the Super Bowl. And I'll see you guys later. Peace.